hello everyone. If you're here for the cabaret and champagne, you're an hour early, so I'm sorry. So you got me for an hour. So I just want to thank you all for coming. Really appreciate it. And I want to thank Aaron, I want to thank Mike, I want to thank Chantal, Nancy, and everyone else who helped out and arranged this today. What a great conference it's been so far, and a great day and a great couple of days. So thank you very much, everybody. So I'm going to start off today by talking about strategies for the market. A lot of things, as investors, we all know and we're all familiar with, but things that have to be reinforced time and time again, because as investors, we constantly forget these things, especially when we get big headlines in the market that tell us that we should be panicking, but we really shouldn't be. So I just want to start off with a quick show of hands. At any point after the 2024 election or the 2020 election, were any of you more optimistic or less optimistic about the economy and the market going forward once you saw the election results? So just, give a show of hands if you see them. Yeah, so exactly. So politics and what happens in Washington is a big part of how we focus on our investments. And the thing is, Washington plays a big part in every aspect of our lives, but should it really play that big of an aspect? So what I'm showing here is just a chart showing the S&P 500 returns since 1953. If you had been invested only when a Republican was a president with the red line, or only when a Democratic was president in the blue line. And what you see is that $1,000 in 1953 under Democratic administrations is $69,000 today. Under Republican administrations, it's $29,000. So you may be saying Democrats are so much better for the market than Republicans. Well, there's a little more nuance to that, but again, those numbers are the numbers, so that's what it shows. But again, why are you letting politics impact how you invest? This green chart is if you just bought and held that $1,000. That $1,000 today would be worth $1.999 million today, that 1,000. So those 69 times your money is pretty good. 29 times your money is good. But I mean, I don't even know what the multiple of $1 million over 1,000 is. So again, just don't get so many times, we see what's going on CNBC or in the financial press. The president's doing this, or back in 2008, we had so many clients tell us, get me out of the market because Obama's going to destroy the economy. And now we're hearing the same thing with Trump. And what we tell our clients is, hey, these guys aren't as important as they think they are. And the bigger US economy is bigger than these few people. And again, this is a great way I like to show this. So two people who could be completely opposite in every aspect, whether physical appearance, style, or policies, are Donald Trump and Barack Obama. Yet during President Obama's 8 years in office, the top 3 performing sectors were consumer discretionary, technology, and healthcare. Wasn't he supposed to destroy the healthcare sector? But again, that's what a lot of people thought, but the market did pretty well, and especially healthcare. Then under Trump, the first 4 years of his administration, those same 3 sectors were the top performing sectors in the market. So again, 2 completely different people and same ranking of returns. Again, and the energy sector was the worst performing sector under each president. Even though President Trump was talking about drill, baby, drill, a lot of supply isn't necessarily good for oil companies when they're looking at when they want to keep supply scarce. So again, 2 people who couldn't be more opposite than each other, similar type environment of returns. And so if you have had time to follow the news today, we've heard a lot about President Trump maybe firing Fed Chair Powell, or maybe not, depending on what time of day you looked at. And what we hear about is that it's so terrible how this is unprecedented, this criticism of the Fed chair and the independence of the Fed. I mean, we've never seen this. But throughout history, who do you think has been the gold standard of central bank chairman, Fed chairman? Anyone have an idea or want to, Exactly, Paul Volcker, all right? So Paul Volcker was appointed by Jimmy Carter in the 70s. In the 1970s, as he was raising rates, Carter was criticizing him for raising rates. A member of the House of Representatives was urging him to resign, and Ted Kennedy was out there saying we should end Federal Reserve autonomy. I mentioned this before in our panel. Again, so this whole aspect of politicians criticizing the Fed is nothing new. In the social media world we're in today, it comes out a lot more, but this was nothing new. There was even a suspect arrested at the Capitol with a gun threatening to take Federal Reserve members hostage because rates were too high and inflation was too high. So, and then what's great is at the end of 1982, when the Fed announced that they were going to stop raising rates, in the New York Times, headline here you see in the top right, Volcker's monetarist policy, painful and costly. So what it said in that article was that Volcker's policies, while they shaved inflation by a couple of percentage points, the costs far outweighed the benefits, and that it was more pain, more harm than good, what he did. In retrospect, it's a whole nother story. So now that's the thing. Do not let politics, again, guide you in your investment decisions. And we're in Vegas, so I thought I'd include this slide here. Unlike the casino, where the longer you play, the more likely the casino is going to take your money, in the market, your odds are better the longer you play. So the holding 1 month, you have an average gain, your likelihood of gain about 62% of the time. If you hold for 5 years, there's 90% of 5-year periods have been positive. But the longer your time horizon, 16 years, we call it the Joe Montana because Joe Montana for the 49ers wore the number 16. There's never been a 16-year period in the market where we've seen the S&P have a negative return over those 16 years. Being from New York, I'm a Met fan, so I originally wanted to call this the Dwight Gooden rule, but his career didn't sort of end the way that Joe Montana's did, so I didn't think it would be a very good association. And then one of the things we're talking about here, and Larry McDonald was talking about this earlier in his speech, about how the massive amounts of debt we have in the US economy is going to cause us to monetize the debt, and we have to have hedges. So when you look here, and stocks are generally thought of to be perform negatively during periods of inflation. And in the short term, they do. But over the long term, they've been like kryptonite for inflation. So if you have $1,000 at the end of World War II, its purchasing power today is under $100. $1,000 in the stock market at the end of World War II with dividends reinvested is worth $5.5 million, outperforming inflation as measured by the CPI by 30,000%. Okay, so, and when you compare stocks to other asset classes, this is just since 1995, over the last 30 years, you see that the S&P 500 has trounced gold, it's trounced real estate, obviously it's trounced the bond market, and even commodities as a sector over that entire period, stocks have outperformed and leaving these others in the dust. There's definitely periods where you want to be invested in certain other asset classes, depending on the macro backdrop, but long-term, stocks are your answer. And then we're looking today, the markets, I think the NASDAQ closed at a record high today. You say, Paul, come on, the market, look at this rally we've seen in the last 3 months. Do you really want to be putting new money to work here? And, yeah, market is richly valued right now. But again, another speaker was talking about nobody knows what the future is going to bring, and nobody does know what the future is going to bring. Things can keep going higher, become more overvalued, or they can crash and burn. But if you think of the 4 worst periods over the last 40 years to get long, it would be the day before the 1987 stock market crash. It would be in early March 2000, right before the dot-com bubble burst, or in October 2007, right before the financial crisis, or in February 2020 when COVID hit. And if you look at the market's returns, the S&P has nearly doubled the performance of bonds since right before the 87 crash. And it's nearly doubled the return of bonds since right before the dot-com bust. And you would have put money to work there and been thinking oh my gosh, what did I just do? But again, time's on your side in the stock market, and just keep your strategy. You don't want to be extreme at any different way. You want to keep a strategy of gradually adding and averaging into the market. So time is on your side. So the question is, where do you want to look for to invest, right? So like, what's the best places to look? And one thing I'll show you is the best piece of advice I'll give you is to take the front page of the paper and rip it off, all right? And throw it away, because what's on the front page of the paper is worthless as an investor. We constantly look at the paper and we say, oh, what's the news today? But that news is meaningless to what's going on in the market right now. What's going on in the market right now is from factors that the market was pricing in. What's going on in the economy right now is what the market was pricing in months ago. So the perfect example of this. These are all New York Times front page headlines. I could have used any paper, but this was the only one I had access to at the time. But it's all headlines from April 9th to May 9th of this year. And if you look at all these headlines, they're terrible. It's talking about tariffs, how investors are losing faith in the US economy, how the war in Ukraine is going terrible, how China's going to halt rare earth exports to the US. I mean, you would look at this and you think, oh my gosh, this is really bad. Do I really want to be investing in the market in this kind of environment? Well, here's an intraday chart of the S&P 500 during that month, and what you saw is a rally, a retest of the lows, which is very common off of the market bottom. You tend to see a short rally, a pullback, the prior low doesn't get violated, and then the market keeps going from there. And in this month period, we were up over 12% in spite of all those headlines that we saw. So money isn't made on the front page, and there was a great, Warren Buffett was talking about it in the annual meeting this year when he talked about finding the Japanese trading companies that he found. He had a big book, it was like a phone book of stocks, and he just said, turn the page, keep turning the page, because most people only look at that front page and they don't turn the page, but the best ideas are found later on and where no one else is looking because they haven't been discovered yet. And what's usually on the front page is what all the experts agree on, right? And this great example is back in November 2023. We saw right before the Argentina election, Javier Milei, 100 economists came out and warned of the devastation we would see in the Argentinian economy if he was elected. Not to mention, the Argentinian economy was pretty much devastated already, so I don't know how it could have gotten much worse, but that's a topic for another discussion. But so he did get elected, and what happened is, since that article was published, the best performing stock market in the world is Argentina. And this isn't in local market currencies. This is on a dollar-adjusted basis. So as a US investor, all of the different ETFs you could buy of different countries, Argentina has been the best performing stock market since this article was first published. So what we like to say is if there's widespread agreement among everybody on a certain outcome, run in the opposite direction. What we say is turn the page, is what Warren Buffett said. And I think this is a good example here. In early 2020, the market was doing well, hitting highs. Suddenly, on the way down low on the Drudge Report, you started to see headlines about this mysterious virus in China raising havoc. And then it slowly crept its way up above and like to higher stories. And even in December of 2019, there was an article from Reuters talking about a higher than expected flu season from an unexpected virus going around in the United States. So these types of things, not all back page stories make it to the front page, but when you look at the back page and you keep seeing those same stories appear and moving from page 20 to page 17 to page 15 and on, that way you have a trend working in your favor. And so just like the front page you shouldn't focus on, front page stocks aren't necessarily the best way you should look at things here, because the leaders of today are unlikely to be the leaders of tomorrow. So on the left-hand side here, I have the 10 largest stocks in the S&P 500 as of the end of June this year. Average return over close to 4,000%, median gain 836%. Against the cap-weighted index or the equal-weighted index, they've trounced them. NVIDIA is up 31,000% over the last 10 years. I mean, some of these gains are just massive. Now, on the right side, what I'm showing is the 10 largest stocks as of the start of 2000 and their performance since then. And when you look at NVIDIA, 31,000% is pretty impressive, but look at Cisco, it's over 85,000%. And John Chambers, I don't think he ever even wore a leather jacket when he was on TV. He was just in a blue shirt, plain old outfit. But what's important here is what you look at the performance of these stocks over the last 25 years, only 2 of them have outperformed the S&P 500. 4 are down, and collectively, they've had less than half the performance of the S&P 500. So again, the leaders of today's leaders won't necessarily be tomorrow's leaders. And this is an interesting thing here. If you look at the largest stocks as of 2000, there was a story going around that the AI bubble is bigger than the dot-com bubble because the PE of the 10 largest stocks today is higher than the PE of the 10 largest stocks then. But if you look at the 10 largest stocks back in 2000, you had ExxonMobil, you had Citigroup, a bank, you had IBM, which wasn't a new company, General Electric was an old company. So these had much more established companies tend to have lower PE. So I think that's one of the nuances in that story that was going around today that you have to dig a little deeper to. So now looking at the 20 best performing stocks in the S&P 500 now, I was talking about this in the panel before, is that the top 6, Monster Beverage, consumer staples. Would you ever thought a consumer staple stock would be the best performing stock over a 25-year period? Monster Energy, though, is from the consumer staple sector. Deckers Outdoors, NVIDIA, Texas Pacific Land, and Old Dominion Freight. Top 6 companies are all from different sectors. So you don't have to focus just on the tech sector to find the winners of tomorrow. They can show up anywhere. And so that's just, again, the whole aspect of what Warren Buffett said, turn the page, look everywhere. So back in May, we were looking for different stocks, high growth stocks. So we publish a lot of different reports for our research clients. We have some AI baskets. We have the Bespoke 50, which is a list of stocks. And then we have our triple plays, which are companies that report better than expected earnings, sales, and raise guidance in an earnings report. And we tend to look for companies that make a pattern of doing that. So going through this list, we looked for some small stocks that fit into one or more of these categories that were in some interesting sectors. And we called them long shots because we don't expect all of these stocks to do well. But we'll probably be wrong on a lot of them. But if 1 or 2 of them hits, that can make up for losses in a lot of other names. So these names they're not necessarily technology stocks, but they're using technology in their businesses to improve things. I mean, Lifetime Fitness they make sports clubs, and athletic clubs for, private clubs. It's a for-profit company. It's hardly a high-tech company. You have some, learning stocks, LRN, and you have PRDO, which are in the education sector, which the online education hasn't really done what people have thought, but with AI, it has the potential. So it's a long shot. Not saying it's going to really go crazy here, but it's got the potential. It's in the right. If the right things go for it, that's one that could rally. And then so what we're showing here is just that it all takes is one. If you have a portfolio of 10 stocks, and you have one go up 10-fold and you have the others drop 50%, you're still up 50%. If you have 8 stocks go to 0 and 2 go 10-fold, you've more than doubled your money. Again, these are extremes, but the key is that you're going to have a lot of losers, but some of the winners will outweigh many losers. As long as you spread, you don't want to go too focused all in on one specific name. As they say, don't put all your eggs in one basket, right? And this is a great example of this. So what you see here is this chart compares the growth of the S&P 500 over the last 25 years, which is that blue line. And then the 3 other lines are if you invested $1 in Monster Beverage, $1 in Deckers, or $1 in NVIDIA. So $100 in the S&P 500 versus $1 in one of those 3 stocks. all three of those stocks, you would have had more after 25 years with that dollar than you would have had with $100 in the S&P 500. So again, it just talks about the PE investors will often talk about how they spread their bets around knowing that some of these aren't going to pan out, but the more exposure they have to different areas, the better chance they have of finding success or the big winner of tomorrow. Now the key is, so say you know what the big stocks are going to be. You're so convinced that this is going to be the winner. The question is, will you have the stomach to ride that wave? 25 best performing stocks over the last 25 years have been, on any given day, an average of 16.5% from their all-time highs. Their average maximum drawdown is 66%. So at one point, they had at least a 66% drawdown, and they were in 20% drawdowns 40% of the time. So in a bear market, 40% of the time. NVIDIA, the best performing stock over that entire period, that had been in a drawdown of 50% on 43% of all trading days over the last 25 years. Best stock anyone would say offhand over the last 25 years is NVIDIA, but more often than not, you've been getting creamed on it relative to its high. Even Amazon has been, look at those historical drawdowns in Amazon on the bottom right chart. It's, massive drawdowns. Even recently, NVIDIA, even since, we saw AI get launched, ChatGPT, you've seen big drawdowns in the stock. So for the last slide I wanted to show is AI is certainly a sector. Everyone's talking about it, and there's going to be some big winners. It's equated to the internet, and when we look at it, what we think our first thought about ChatGPT was that it brought AI to the masses like Netscape brought the internet to the masses. So Google called itself, or Alphabet called itself, an AI-first company in 2018. ChatGPT came out in 2022. So AI has been a big thing. It didn't just start with ChatGPT, but no one really, the average person didn't really think about it. But so what we did is we compared the launch of Netscape Navigator in 1995, the NASDAQ's performance since then, to the NASDAQ's performance since the launch of ChatGPT in 1995. And what you've seen is very similar trajectories, and we've been updating this on and off for the last, at least the last year and a half. And coming into this year, we were like, wow, are we going to get that big sell-off that we saw in the first half of 1997? And I mean, we didn't necessarily think that was going to happen, but sure enough, that sell-off came. And if you look back through history and you see what was the cause of that sell-off, it was higher interest rates, worries about valuations in the tech sector. I mean, does any of this sound familiar? Tariffs weren't being talked about back then, but again, the tech sector started, the AI trade sold off before tariffs in January when you had the DeepSeek news first break. So the moral of the story here is that if this is if AI is Internet 2.0, you have a lot more runway left to go before this trade finally comes to an end. But you're going to see a lot of volatility in the meantime. So that is just one perspective we like to look at, and that's all I have. So I just want to thank you all for coming to listen, and I hope you had a great conference here the last couple of days.
We could do one or two questions if we do have. I know Paul was up on stage before, but if you thought of anything that you didn't get to ask then, please, you've got an opportunity now to get one or two questions in before we move to the panel.
Yeah, that's fine.
Let's see. Was that a hand there? Did I see a hand there? No, I'm not sure. Oh, yeah, over here. Two at the same time. All right, we'll get to you and then you.
I thought I put everyone to sleep.
So your chart showed that stocks have significantly outperformed gold over the long term.
Yep.
And now gold's really hot. It's had a good run. But what would make you think it's not just going to kind of level out and kind of revert to the mean over the next 10 years?
So I don't consider myself a commodity expert and a gold expert. I mean, I have some exposure to gold personally. I think there's nothing wrong with that. And in this environment where there's a trade where we do see this trend of monetizing debt, again, gold can rally. It's underperformed for so long, so it can see a bounce, but it's gone up a lot. I think the first half gain in gold was one of the strongest we've seen in any year going back, I don't know how far. So, I don't necessarily dislike gold, but as far as we, for our clients where we manage money, we stay primarily focused on equities because we have a long-term focus. And when you looked at this prior chart here, the performance of the stock market over the long term, even during, like you think about inflation, if you have inflation, prices are higher, so revenues for companies are going to go up along with that. So there's somewhat of a, sure you have to have higher inflation will cause higher rates, which you have to discount future earnings at a higher discount, but in the long run, sales are nominal. So if prices are going up, if inflation's going up, company sales are going to go up along with that over time.
Paul, we had one more over here where this, yeah, there we go.
Hi, Paul.
Hey.
The chart you showed with AI in lockstep with the internet rise, what are some suggestions for constructing a portfolio to take advantage of that if that continues?
I think having exposure, so this trend we're looking at here is the NASDAQ. So having exposure, it all depends on the type of individual investor. You can take a less active approach and just be long a growth sector, maybe not even the NASDAQ, or there's the Vanguard Growth Index, which is similar but maybe not as heavily weighted in some certain names. But I think or if you're a more active investor, you can take the strategy where you spread all your bets over like a few dozen different stocks and see where the pieces fall. But the key is if you have a certain strategy, what strategy you start out with, you can't decide 6 months later, okay, these stocks did well, I'm going to hold these, but these are dogs, so I'm going to get out of those. Because like I was saying before, do you have the stomach for it, is certain of these names go in big drawdowns, so they go in cycles. NVIDIA was a dog up until, not necessarily a dog, but all of its growth over the last 25 years was just recently. And four years ago, most people wouldn't have been predicting that it was going to have the 4 years it did, whereas other stocks like an Amazon has had big swings up and down over time, but eventually, the path has been higher. But so again, I would just, if you're constructing a strategy, just be prepared for more volatility, because the chart showed to see a lot more. Once you get these valuations to loftier levels, the room for error becomes such that people are going to be more quick to sell at these headlines they should probably be ignoring in the first place.
Excellent. Thank you, Paul.
All right. Thank you.